Okay. Changes in risk aversion. The slope of the security market line reflects the extent to which investors are averse to risk. So if there's an increase in risk aversion, this increases the risk premium, which increases the slope of the security market line. If there was a decrease in risk aversion, this would decrease the slope of the security market line. Changes in a stock's beta coefficient. So the beta of a stock is affected by composition of its assets, the use of debt in financing. So stocks with higher debt are going to generally have higher betas and vice versa. Increased competition, expiration of patents. Think of medical companies with with patents on various drugs or drug companies. I guess when those patents expire, the value of those companies declines because others are allowed to make versions of those drugs. Like they make generic versions of the drugs, and the price of those drugs typically comes way down. Any change in the required rate of return and affects the stock's price. So this could result from a change in beta or expected inflation. So if the required rate of return goes up, we saw this in Chapter 7. You raise the required rate of return, the value of a stock is going to go down. Stock market equilibrium, condition under which the expected return on a security is equal to its required return. The actual market price equals the intrinsic value as estimated by an average investment. This leads to price stability. If this is not the case, where you're going to have buying or selling. So if a stock is undervalued, your investors are at some point are going to realize it, and they're going to buy that stock, and then the price is going to adjust. If a stock is overvalued, investors are going to sell that stock, and the price as a result, price will go down. Changes in equilibrium for stock prices. Stock prices aren't constant. This is due to changes risk-free rate, market risk premium, stock's beta coefficient, stock's expected growth rate. For example, think of companies that might be maturing. For example, maybe certainly Microsoft is a mature company. 25 years ago, Microsoft was a very young company, and the growth prospects were much greater then than they are now. That's just part of the firm's life cycle. Changes in expected dividends. We saw how these returns and growth rates and changes in dividends affected stock prices in the last chapter. Then underlying the risk-free rate is also inflation. So riskiness of real assets is only relevant to with regard to its impact on the stock's risk. So firms' real assets, property, plant, equipment, so forth. The other assets as well. They're only relevant as in relation to how they impact the stock's risk. So, word of caution with regard to the CAPM. So it's based on expectations or expected conditions. We only have historical data. Of course, history may not repeat itself. So when conditions change, future volatility might differ from past volatility. We've seen that in the 2008 recession. We're seeing it right now with regard to the volatility of the of the markets associated with the pandemic. Uh, Estimates are subject to error. Just because you go through the process of estimating the returns and so forth doesn't mean that they're going to be accurate. Um, Different types of risk. So, systemic risks or systematic risks, interest rates, inflation, um, maturity, liquidity, exchange rate, political, unsystematic risk, business, financial, default. These are all related to the firm. The combined risk, total risk, and corporate risk, so forth. That is the end to Chapter 8.